ethylene got tight, the PVC producers were restricted on their ability to get ethylene and make PVC ultimately, and as a result, PVC capacities were constrained and inventories came down as well. Now this is a chart that I put together last month for another meeting that showed you just how much capacity was down during the February, March, April time frame from an ethylene cracker standpoint. Now, what you'll notice here is that many of the major names, some of the biggest crackers that are out there on the Gulf Coast were shut down. INEOS, Shell, Dow, Eastman, Chevron, Phillips, and Equistar and Sasol all had outages either planned or underway during this time frame. Our view was that during this time frame, that as much as 19.5% of the total production capacity would have been offline at any given time. This was huge given the fact that there was already such a low inventory situation prevailing in the industry. Now, things have moderated since then. This is an updated chart. This shows you where we are today. This is an April snapshot. And what you'll notice here is that there are really only 3 major crackers that are offline today. You've got INEOS at Chocolate Bayou, Chevron Phillips at Cedar Bayou, both very large crackers, almost 2 billion pounds a year annually between the two, and Dow and Plaquemine. Now, of these 3 crackers, the Chevron Phillips cracker is expected to come back online this week or early next week at the latest. And INEOS and Dow are supposed to come back up in May. So the situation should be improving pretty quickly here. Now the Equistar or Lyondell cracker there is going down or scheduled to go down in May, but it'll be after all of these others have come back up, so the situation should be much better by then. And as a result, we expect to see the impact on both ethylene contract prices and spot prices as well. Now this chart shows you just how much the spot price of ethylene has been impacted by these outages. Now, if you look at the top line on this chart, it represents the spot price for ethylene on a weekly basis going back to the beginning of December of last year. The gold bar represents the cash cost to produce ethylene during that same time frame. And in the early part of December, you'll notice that there was really very little gap there. The relationship was very much like it typically is for spot ethylene. It normally tracks the cost. There's usually not a lot of margin in spot ethylene. But when we started having all of these outages and ethylene got as tight as it did, you can see what happened to the spread. That purple area there represents the tremendous margin or gap that opened up between the cost of producing ethylene and the selling price of spot ethylene. Again, if you're making ethylene with ethane today, your costs are just over 20 cents per pound, and we saw the spot price peak last week at about 74 cents per pound. So huge margins on the ethylene and spot ethylene contract side. Spot ethylene. Now, one thing we know is these price levels can't last forever. If you're buying ethylene, which some of you in the room here are on a contract or a spot basis, that's good news. If you're selling ethylene, well, you knew that it was probably too good to last forever. But what I'm showing you here is if you look at the yellow line at the top, that represents the historic and forecast view from CMAI of what we call the large buyer contract price for ethylene. If you look at the portion circled inside the yellow, or excuse me, the white circle there, that's really where we are today. You've seen the big run-up that has occurred here in the last several months. And you can also see that we believe that we're right at about the peak for ethylene contract prices today. In fact, our olefins people are forecasting ethylene prices will roll over in April. They peaked in March after this 12.5-cent increase that we saw in the first quarter. They should be peaking they peaked in March. They should roll over in April in anticipation of this capacity coming back online. And then we expect to see a correction maybe in May, certainly by June, as the product starts to flow back into the industry. Now, the other thing that I wanted to show you here was the margins. The margins for an ethylene producer here are represented by the sort of blue bar there. Now, if you look at the horizontal sort of red line there, that's located at the 10 cent per pound line. That's CMAI's view of what sort of traditionally viewed as a required return on investment level for producers to put money back into the industry. Now, if you look at where we are right now in the first and second quarter of 2010, you can see these margins are really at unprecedented type levels, but it's not going to last. And you add to the fact that they really haven't seen reinvestment type margins since the second or third quarter of 2006. So it's been a long dry spell. That's why we're not seeing any new ethylene capacity being put into the U.S. There's a situation right now that is kind of unique. It's absolutely associated with this unanticipated outages and very sort of short-term supply constraints that we've got that have driven prices up and margins up. But we think that once that's corrected here, which again should be in the April-May time frame, prices will come down and margins will correct as well. This chart is simply designed to show you that there has been, as a result of all this, a fundamental change occur in the last several quarters or last several months in the relationship between the price of PVC and the price of ethylene. What I'm showing you here, if you look at the red line, that's CMAI's view of the discounted price to produce or to sell PVC into the contract pipe business. The green line below it represents our view of ethylene average acquisition prices. Now, if you look at all of 2009 and a good portion of 2008, ethylene prices ran well below PVC prices. And if you look at the section there inside of that yellow circle, you can see that ethylene prices have well exceeded PVC prices. So that situation, again, is expected to moderate and get back to more traditional levels here by the summertime. All right, so what's happened with the PVC cash costs here and relative to the selling price of PVC? Again, the white line at the top of this chart is CMAI's view of historic and forecast pricing for PVC resin sales to the pipe market. The two bars there, the green bar and the yellow bar, represent our view of cash cost for an integrated producer with the dark green bar and a non-integrated producer with the yellow bar on a quarterly basis to make PVC. Now, when I talk about an integrated producer, I'm talking about somebody that is back integrated into ethylene and chlor-alkali. A non-integrated producer has to go out and buy those. So if you look at the red section there, which is where we are today and where we have been, you can see where the problem lies for PVC producers. Whether you've been integrated or non-integrated, you've really been challenged to make a profit. And in fact, your margins have been negative, particularly so if you're a non-integrated producer. You can see where that yellow line exceeds the cost, where the yellow bar exceeds the white line there. It's just been very, very challenging for those producers to eke out any kind of margin whatsoever. In fact, our view is that going forward, if you're a non-integrated producer, it's going to be extremely challenging for that business to be profitable. We expect those costs to trend right along the price for PVC for the next year or two. So if there's any business or any capacity in the U.S. that's on the bubble that may have to be shut down, it's this non-integrated piece that's still out there. All right, we've talked a bit now about the ethylene impact, and I think you've seen how significant that can be to production costs, how significant it can be to margins, etc. Now I'm going to shift gears for a minute and get back to this concept that we talked about earlier in the presentation about this whole idea of weakened integrated economics. Now, again, we said integrated economics is a producer that has chlor-alkali and ethylene, etc. Now, in this case, we're focusing on the chlor-alkali piece. Chlor-alkali, again, is the chlorine and caustic soda piece of the equation. Now, if you're making chlorine, you're also making roughly equal parts of caustic soda. Now, what we do is if you look at the combination of the return on that chlor-alkali piece, it's referred to as the ECU value. That's represented there by the yellow line at the top of the chart. And the margin associated with that, again, the sale of the chlorine and the caustic, is represented by the red line.